Hello and welcome back to the Notes, and I'm afraid the week has started with an intensification of the financial concerns that have been gripping the world. It's no longer about commodities or oil or emerging markets. The great source of concern now is the main financial institutions in Western Europe and the US. Perhaps the biggest source of news that people are worried about today is from the great concern over Deutsche Bank. This is their CDS spread. This shows you what people are prepared to pay to guard against the possibility of a default by Deutsche, and you can see it's shot up recently. The perceived risk of default is now higher than it was at any point during the Great Crisis of 2008. It's approaching the levels it reached during the Eurozone crisis. Now, that has had an effect here in the States. If we show you this next chart, you can see that the S&P 500 banks index is now in a true bear market, down more than 20% from its high not so long ago. And there have been some very sharp falls for some big banks today. Now, what's intriguing is if we now show you what this same index looked like in the 5 years leading up to the dawn of the credit crisis in the summer of 2007, you can see they're remarkably similar. In fact, banks had built up more ahead of this latest sell-off than they had then. Why are we seeing such a degree of concern over the banks? Well, the critical reason we can show you here, it's the Treasury yield curve. This shows you the gap between the interest rate paid on 10-year bonds and 2-year bonds. Broadly speaking, this is how banks make money. They will lend you money at a very much higher rate over a long term than they will receive your money. They will pay you an interest on current accounts over a much shorter term. The bigger that gap, the easier it is for them to make money. When the Fed started raising rates, the idea was that this would help widen the yield curve, make it easier for banks to make money, and thereby slowly but surely improve their financial position. It's not happening. We now have the flattest yield curve at any time since the crisis began. Furthermore, if we take another look at the bond market, what the bond market is telling us, 10-year inflation break-evens, the implicit forecast for inflation that you can derive from the bond market is now as low as it has been since the crisis. You can see it's far lower than it was in 2010 when it sparked QE2 from the Fed, or 2011 when it sparked Operation Twist. This is a very, very concerning move in the financial market. Now, why do we see this degree of concern? Well, let's take a look at this next chart, which shows you the yen. I suspect this latest big bout of concern stems from the Bank of Japan's shocking decision a couple of weeks ago to announce that it was going to go to negative interest rates. The idea was that this would show it was prepared to weaken the yen. What the signal that the market has taken, however, is that any central bank, all central banks, can, if necessary, move to negative rates. The result is that after that initial shock, you can see there, the yen is now actually stronger than at any point since the beginning of last year, completely reversed out. It's only really possible to explain that if you believe that there is a scare that rates could go negative. Obviously, that would be terrible for banks. You really can't pass negative rates on to your consumers. Banks would have to eat that. It would be very difficult for them to make profits. Now, if we take a look at this final chart, the gold price, similarly, you can see obviously depressed for a long time. It has shot up recently. It appears to be staging a breakout from that very advanced long-term downward draft. That has also stemmed largely, it seems, from when the BOJ made its announcement about negative interest rates. Negative interest rates, were they to happen, would obviously be good for gold. One of the big disadvantages of gold is that it has what people in the market would call a negative carry. You have to pay money to hold it in a vault. If you actually have to pay money to hold cash in a bank account, gold's great disadvantage becomes much less. Also, obviously, when you see gold rising like this, it shows great concern about whether the central banks really can hold things together. Now, this is obviously a very scary momentum. What many people are hoping is that Janet Yellen will signal that the Fed is not going to go ahead with raising rates, but will also presumably find some way not to suggest that she's going to go to negative rates. We hear from her on Wednesday. That could be a very important day.